In this lesson, we'll cover basic options terminology. This is a majority of the terminology that you'll hear when trading options. Your options chain, in the money, at the money, out of the money, calls, puts, time decay, intrinsic versus extrinsic, the Greeks, and implied volatility. The definition of an option is a financial instrument based on the stock, giving the trader the right to buy or sell shares of a company based on if the stock will or will not hit a specified price before a specified date. The options chain. The options chain is a matrix listing for a single underlying asset showing all puts, calls, strike prices, and pricing information for a given maturity period. Many online brokers and stock trading platforms display option quotes in the form of an options chain using real-time or delayed data. This is the options chain. On the left-hand side, you have your call side. This means you're bullish on the underlying. Moving to the right, you have your expiration. Next would be your strike price. And then on the far right side, you have your put side, which means you're bearish on the underlying. You can customize your view based on the information most prevalent to what you're trading. In the money. A call option is in the money when the current market price of a stock is above the strike price on a call or below the strike price on a put. It is in the money because the holder of the call or put has the right to buy the stock below its current market price. When looking at the options chain, anything that's highlighted in that purple color is in the money. At the money. An option is at the money if the current stock price is equal to the strike price. It doesn't matter if it's a call or a put. Any call or put whose underlying stock price is equal to the strike price is at the money. Using our purple highlighted area as our point of reference, at the money would be one strike below on the call side and one strike above on the put side. Out of the money. A call option is out of the money if the current price of the underlying stock is below the strike price of the option. A put option is out of the money if the current price of the underlying stock is above the strike price of the option. A good reason to use out of the money options is if you're looking to get a greater than expected move and limit the amount of risk that you're putting on, keeping in mind that your theta is going to eat up on the time decay, which we'll cover soon. Call options. A call is a bullish bet that the underlying will move higher. It gives you the right to buy 100 shares at the strike price by the expiration date. There's two types of calls, long versus short. A long call is buying the option, whereas a short call is selling them. A long call carries unlimited profit potential with the risk being defined by the purchase price. Short calls have unlimited risk and limited profit potential. Put options. A put option is a bearish bet that the underlying will move lower. It gives you the right to buy 100 shares at the strike price by the expiration date. Long versus short, like a call, a long put is buying the option, whereas short put is selling them. Long puts carry unlimited profit potential, with the risk being defined by the purchase price. Short puts have unlimited risk and limited profit potential. Decay. Time decay is the ratio that your option loses value. Decay occurs more rapidly the closer it gets to the expiration. This is displayed by the Greek theta in the options chain. Intrinsic value. Intrinsic value is the perceived or calculated value of an option. The term finds use in fundamental analysis to estimate the value of a company and its cash flows. Another use of intrinsic value is in the amount of profit that exists in an options contract. Extrinsic value. Extrinsic value measures the difference between the market price of an option, called the premium, and its intrinsic value. Extrinsic value is also the portion of worth that has been assigned to an option by factors other than the underlying asset's price. The Greeks. Delta. Delta is the amount an option price is expected to move based on a $1 change in the underlying stock. So if you have a delta of 40 and your stock moves from 200 to 201, you can expect to make 40 cents on that option. Gamma. Gamma is the rate that a delta will change based on the $1 change in the stock price. So if delta is the speed at which option price changes, you can think of gamma as the acceleration. Options with the highest gamma are the most responsive to changes in the price of an underlying stock. Theta. Theta is the amount the price of calls and puts will decrease for a one-day change in the time to expiration. Vega. Vega is the amount calls and put prices will change, in theory, for a corresponding 1-point change in implied volatility. Implied volatility. Implied volatility, or IV, refers to a stock's anticipated volatility of the stock in the future, without regard for the direction. IV is determined using an options pricing model. Although the marketplace may use implied volatility to anticipate how volatile a stock may be in the future, there's no guarantee the forecast will be correct.